Alrighty, let's go ahead and get started. Welcome everyone to the HUBB Live Trading Room. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. Main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Main headline of today, of course, is regarding crude oil and the fact that a barrel has fallen under $100 due to the Trump and Iran talks negotiations being in their final stages. So, interested to hear Rob's thoughts on that, amongst many other topics, and of course, very excited to interact with you all. So let's go ahead and kick off. Rob, you out there?
Hey, I'm Zach. Hey, everyone. Welcome to the HUBB Live Trading Room. And Zach hit some of the highlights. Quite a bit of news going on today. We're going to get the release of the Fed meeting minutes this afternoon from the last meeting. Probably doesn't mean a whole lot. We have Chairman Warsh starting his tenure now. So I've been talking over the last couple of webinars on it's going to be interesting to see. Seems to be a dichotomy there, viewed as a monetary easing type governor, but yet said he doesn't like the size of the Fed's balance sheet. And that signals a withdrawal of liquidity if they shrink the balance sheet. So, how do those two balance out? Very difficult time to cut rates with inflation. They just showed the core PPI, which is on the producer side, which was quite elevated. And that has to do with and the core, remember, is X food and energy. So a lot of people, including myself, think that's just kind of a manufactured number because it makes inflation look lower. But the excuse is that, well, food and energy are volatile, so it doesn't give a good reading if you keep those in because the readings can be all over the place. But we have to pay for energy and we have to buy food. So as consumers, I think it matters. But the issue is the core without food and energy is still elevated, and people are wondering why. But it's just important to remember that oil, as Zach cited, so we'll take a look at the chart of oil and come back to the S&P, is down a bit today. Nothing of real significance, but it is lower. And, I think we're all kind of immune now to the rhetoric on where the conflict in Iran stands until something's actually signed. Posturing back and forth between the sides, threats, and all kinds of things going back and forth. What does it'll end when it ends? But oil does permeate into other areas. Only half of oil goes into direct energy prices. The other half of oil goes into other sectors, which is why the core is higher. So that's creating issues in the bond market. So there's the chart of oil. So you can see, even though it's down today, it's not really anything of significance, at least as by the evidence of the chart of the USO. Let's go to the bond market real quick because that's to me where all the action is. If you happen to watch Trade Finder yesterday, I was talking about how on this low of the day yesterday, we were getting awfully close to that 161.8% extension of this zigzag. Perfect 61.8% B wave correction, or right there, gives you a 100% expectation and then possibly an extension to the next fib level. Doesn't happen as much in a wave 5 as it does in a 3, but it did here. But we were oversold in the bond market yesterday. And so this is from the earlier tick this morning. We've actually had a further rally in TLT, meaning prices are going up, yields and rates are going down. But I cautioned yesterday that any sort of rally like we're seeing today has to be met with a little bit of caution as well, because does this mean that the bottom is in prices and therefore the high is in on rates? Or is this just correcting an oversold condition and we're destined to go even lower in price and higher in yields and rates? We don't know the answer to that yet. But nonetheless, on that report that Zach cited, we did get a rally in the bond market and therefore a subsequent rally in the equities market. And I've often mentioned that to be a good equities trader or derivatives, options, etc., you don't have to be an expert in the bond market, but you should have a good working knowledge of the bond market because bond market is so big. There's so much money there. viewpoint that there's a lot of really smart people in the bond market, and the equities market tends to get its cues from the bond market. Seems to be even more correlated right now with the fact that yields have spiked up to levels. I mentioned that the 30-year was as high as it's been since 2007 yesterday. But a little bit of a break today. So far, the rally in the bond market is holding. We had a big run up, and then we've gone sideways since then for the last hour or so. So that puts us up around 84. So this would be the level of where, in fact, the high was exactly at 84. And when we get the end of the day, that 10-day will come down a little bit. And with the price up, we're getting awfully close to moving back to the 10-day moving average. That rule, no security in any time frame gets too far from the 10-day moving average, applying once again in the bond market. So do we continue the rally? Could we come all the way up here and fill this gap? Or are we just correcting an oversold condition? And as I mentioned, maybe heading back down. That's going to determine, I think, where the market goes in the short term. And then, oh, by the way, NVIDIA reports earnings after the close with everything else going on. That would have been the main headline before all the other stuff that's been occurring. What's going to happen here? There's a 6% move priced in to NVIDIA's earnings. I don't think anyone doubts that they're going to have a great earnings report and great guidance. Um, Jensen Huang, the CEO, has been out talking about it for a very long time, and he was just over with President Trump in China talking about how much demand there is. So the question's, how does the market view it? How does the market respond to the report? There's been a lot of good earnings reports that have been met with selling, but there's been a lot of good earnings reports, Intel, et cetera, that have rocketed higher based on the movement. As far as options activity today, so far, the largest option trade has been a call debit spread, bull call spread, if you will. So someone made a really big bet that NVIDIA's earnings will be met positively. Hope they're right because it was a whole lot of money that they put into it. So, we'll see how the market reacts to it. Again, that's going to be the key, not what they say, how the market views what they say. Are we shifting away from a slightly bearish narrative on tech? Tech did do well yesterday on a little bit of a pause in the open where the rates opened yesterday at the high, and then still finished as we go back to the chart of the SPY with a little bit of a down day. Taking some of that back now, but can we hold it into the close? And then how does the market react at the end of the week going into a holiday weekend? That'll be key as well. So lots of stuff to talk about, but the key here is what I've been saying over the past few days is even though up until today, the tape has felt pretty negative, pretty red tape, as they say, lots of selling. No real technical damage has been done yet to this move. Really hasn't been. We got a nice consolidation right through here in April, and then we went up to a new high, but we got a little too vertical there and came back down. And so right here, we've gone and done another nice consolidation, corrected that vertical part of the move there where we got a little bit overbought, got a little separated from the 10-day, and so another nice consolidation. So if we continue to do that, I would argue we're going to need help from the bond market. It's going to be a while before we see Chairman Warsh's first actual press conference, and a couple months before we see what they actually do. Those liquidity charts that the HUBB data scientists show us each and every week. I report those during the U.S. market update on YouTube, as you know. I think are going to tell a big part of the story of what they do. Most people think they won't do anything as far as a rate cut or hike, even though the chance of a hike has certainly been heightened with the inflationary pressures. How much credence do they give that once the conflict is over, the strait is open, oil prices come back down? Will that bring inflation down quickly, or is it going to take some time? I'm in the camp that it may take a little while to feel that before it gets filtered through, because it's going to take a while for all that oil to get to its respective ports and then into refineries, et cetera. So I think there's some challenges for the market to go higher, but the market has been, as they say, one of the old analogies, climbing a wall of worry. And that's the part that I think is really important when we get to sentiment. Sentiment indicators are really key. When the market views everything one way, tends to go the other way. Or when traders view the market one way, the market tends to go the other way. And people wonder why. It's the path of least resistance. When everybody's loaded up on one side, you can go the other way. I don't think we're really in that standpoint. I don't think the market is all loaded one way or the other. I think there's a lot of bulls and a lot of bears out there with where we are. You could argue that we might be leaning a little bearish with everything that's gone on. That would be maybe a little bit of fodder for the market to continue higher. But boy, we're right at that 61.8% wave five extension based on a 38, roughly 38.2% wave four correction. That's a pretty good extension. We could go higher. We could go to the next fib level. That gets us above 750 and starts to bring 800 into play. But I think we're going to need a lot of help from the bond market before we can start thinking about anything along those lines. Um, so continuing to watch how bonds act. There's a auction. We'll probably get the reports of that maybe during this broadcast today, bond auction, and we'll see what the response is to that. Seems rather muted at this point. Looking at a intraday chart of the TLT, still showing that we are um, sideways since the early rally. So maybe it was just a ho-hum auction today. So the question becomes to me, and I still feel like even with this little bit of a pullback, that's healthy. Even a test of 725, you could still remain bullish. We break below that, then we're coming down here towards the 710 level where we consolidated in April before we find any sort of support. So right now we're just kind of hugging that 10-day moving average. We'll see where things go from here. For those of you that still like to look at the VIX, not really telling us a whole lot, just kind of in between what would be considered a lower level down around 15 and where we consolidated in the highs between 25 and 30. So we're still right here in the middle where we've been the past 2 weeks. So that I think shows you the balance that there are a fairly balanced amount of bulls and bears at this point right now. So I think that's what the VIX is reflecting from a volatility standpoint. Little bit to take regardless of what side you're on. If you're bullish about the market, then you would look that while there's still a lot of room for the VIX to come down to 15 before it actually finds some support. If you're bearish, you're thinking, wow, there's a lot of room up to 25 for volatility to come back in. So I go back to the keys again, which I think are the bonds. Watch what happens in the bond market. And just to give you a few more signals here, there's the TNX, there's the 10-year. Now that doesn't reflect today's move yet. That's yesterday. So it takes longer to update the TNX than it does TLT because this is actual rates. And so we don't get that till the bond market closes. And then if we look at SHY, which is on the shorter end of the curve, this is a little concerning, a little bit of a tick up, but not like we had on the TLT. So both SHY and TLT reflect prices on bonds, and then yields are the opposite. So you want this to be more. You want a bigger move up on the shorter end because you want rates coming down on the short end of the curve. It's okay if they stay elevated out towards the 30-year because at least we would have a steepening of the yield curve. It wouldn't be great to have rates higher, but it's still, if we had rates lower on the short end and then the long end, then at least we have a little bit of a sign, if you will, that there's some economic strengthening going on. So we're going to continue to watch this. For those of you that have been looking at the AI signals, the Hub organization is integrating some new data, a new data provider which I think you're going to really, really like once it's announced. So I don't want to jump the gun here. But with the work that's going on, you've probably noticed that there weren't AI signals from last night. That'll be corrected. Again, working with that uh, new data provider to bring some really cool new features from a data standpoint to the software platform. And so that doesn't leave us a whole lot to talk about. Normally, at this point, we would go to looking at the charts and trying to figure out, where's a good place to go, and if there are any signals that we would consider putting on a um, putting out an alert. So I'll just cover a couple of these, and then we'll just jump right to the Q&A. Maybe we'll have a little shorter session here while they are integrating that new data service. So with the bounce here off the 10-day on THG, it's only a 55 signal, so rounded up to 56, still too low, as you probably all know. For those of you that are new, I'll tell you the signals. That box is gray, so that's in a gray area. Reference there, a little more than a toss of a coin on this one moving higher. I think that's probably appropriate because we're at a little bit of a toss of the coin of what's going to happen with interest rates and insurance companies and financials, along with the metals, pretty sensitive to rates. So rates are a big deal for a lot of different sectors. And if we don't get a continued follow through with prices up and yields and rates down, I think it's going to be challenging for insurance. But if we do get a move higher in price and down in rates, then we could see insurance move to the upside. So you may be wondering, well, rates have been elevated. Why is it going up? Well, insurance is also one of those defensive type sectors. Um, when the market gets a little squirrely like this, money tends to gravitate towards defensive minded sectors. We talked about the Sen stocks. I talked about that yesterday, tobacco, alcohol, and gambling, with the viewpoint ever since I've been trading. The viewpoint's been that in times of economic strife, we're still going to find a way to participate in our vices, drinking, smoking, and gambling. Um, but insurance is there as well because people have to have insurance. So we cut out other things to make sure that we can still have money for the necessities. And data has shown that the consumer has stayed consistent in their spending, but they're spending more on oil, obviously. So we're spending more at the gas pump. And that means that money is being taken away from other areas. You've seen some retail cracks, et cetera. And so that means that some sectors are not performing well, others are. You've seen in those macro charts from the data scientists at HUBB that more areas are actually in contraction than expansion. AI remains the key. That question was asked yesterday. Uh, would the big tech stocks resume a new upward move? I think they will. But I think we need to find out, is the Fed going to withdraw liquidity? If so, how rapidly? I mean, if it's a long-term plan, wouldn't be as significant. And then, so liquidity is going to be key. And then also um, where we go with inflationary fears, et cetera. So this is why we've had a little bit of a run up, in my opinion, for what it's worth, is because of the defensive-minded nature of insurance. But at some point in time, um, if we stay with slightly higher rates, but we take away the conflict, energy prices slowly start to come down, the consumer is able to maintain spending, I think money is going to go right back into those big AI stocks because that's the hot sector, and it's probably going to be for at least the foreseeable future, not indefinitely, but for a little while. So I just thought I'd give a little dissertation there because I thought this was kind of appropriate to see an insurance company that's had a little bit of a move up. It did break resistance at 185, but yet the AI is not not by any way, shape, or form saying load the boat, back up the truck, whatever on this. So um, we go to the bearish side. Again, so this is not last night's data, but I think this is one that's worth talking about as well because this is in consumer spending. Build-A-Bear, um, not familiar with trading this per se, familiar with the company. They used to advertise all the time. If you remember that years and years ago, they advertised on TV all the time. Basically, you build custom teddy bears, etc. But they've branched out into other areas. But it is a consumer related stock, and you can see it's had a pretty big move down. And the AI thinks that there's a likelihood that we continue lower. I think you'd want to be a little bit patient on this because this area here tried to get broken below, and then we came right back above it. So that 35-ish level there is key for this one as far as a potential bearish signal. There's still this is what's attractive about it, is there's a pretty decent move down to the target price around 28, even though the signal is only at 63%. Um, it makes sense to be bearish here for a lot of different reasons. And then your stop on this would be up here because resistance is at 40. If it got above 40, then you would certainly be out because then we could start climbing back from that big downward move. But a break below 35, it looks pretty interesting to the downside here. And again, plays in with, consumer maybe cutting back on certain expenditures because they have to pay more at the gas pump, unless you drive an electric vehicle, obviously. But uh, we'll have to monitor consumer spending. One of the research places that I listened to said that we had um, evidence that um, the consumer was still okay. And that was part of that report I cited, that more money is going to gas and oil, but the consumer is still spending the same amount, just spending it on different things. If the consumer starts to break a little bit, in other words, pull back on their spending um, in general, then this would be also more intriguing. So I've got this one on my watch list, keeping an eye on that 35 price level. So with that, really not a whole bunch else to talk about on the AI side of things. So we'll go ahead and open it up to Q&A, Zach.
Thanks, Rob. At this stage, there aren't any outstanding questions. So,
All righty. Well, with that, we'll see what the Fed minutes say at 2 p.m. Perhaps that moves the bond market, as the today's auction didn't seem to move it. Maybe I have to look back and see what maturities were being auctioned today. Maybe it was on the shorter end. In fact, let me take a look at the SHY real quick and see. Um, yeah, not really much happened there either. So apparently it was just a ho-hum bond auction, not enough to move prices and rates. Um, Maybe the Fed minutes say something, but I think they're going to be kind of taken with a grain of salt, as I mentioned before, because that was with the previous chairman, and now we have a new one, and we're all going to be waiting to see what Chairman Marsh has in store for us from rates and liquidity. So with that, thank you for spending a little bit of a time on your Wednesday trading afternoon with us, and we will have more information during tomorrow night's insiders meeting, so make sure to attend that. So have a great rest of your trading day. Look forward to talking to you soon. Take care, everybody.